Picture this. You have worked hard to build your life with someone, and part of that shared journey includes joint bank accounts. Now, as you navigate a divorce, a crucial question arises. What happens to all that money? It is a common concern, and understanding the answer can bring a lot of clarity during a challenging time. During a divorce, money held in joint accounts is generally considered marital property. This means that these funds are subject to division between both spouses, regardless of who deposited the money or whose name is primarily associated with the account. The specific way it is divided, however, can vary significantly depending on where you live and the unique circumstances of your marriage. The core reason behind this principle lies in marital property laws, which vary by state. Most states follow either a community property or an equitable distribution model. In community property states, marital assets, including joint account funds, are typically divided equally, meaning 50-50. In equitable distribution states, courts aim for a fair, but not necessarily equal, division. Factors like each spouse's income, contributions to the marriage, and even their future earning potential can influence how the funds are split. This complex legal framework is why it is so important to understand your local laws. To protect your financial interests, it is generally wise to take some practical steps as early as possible. First, gather all statements and records for joint accounts, providing a clear picture of balances and transaction history. While it is usually not advisable to empty a joint account, you might consider closing the account and dividing the existing funds into two separate accounts, or at least setting up your own individual account for future earnings. Communicate openly with your attorney about these accounts and follow their guidance on how to manage them, especially regarding any necessary temporary orders or agreements. An often overlooked but vital step is understanding the distinction between marital funds and separate property. Even if money is in a joint account, if it can be clearly traced back to a source like an inheritance or a gift received by one spouse during the marriage, it might be argued as separate property. This concept, known as tracing, can be complex and requires detailed documentation. Also, be aware of the status quo rule in many jurisdictions, which encourages maintaining the financial situation as it was before divorce proceedings began to prevent one spouse from unfairly depleting assets. Ultimately, managing joint accounts during a divorce is about careful documentation, understanding your state's specific laws, and strategic planning. By being proactive and seeking professional legal advice, you can protect your share of the marital assets and set yourself up for a more secure financial future. Remember, knowledge and preparation are your strongest allies in navigating this part of the divorce process.